Hey guys, it's day 5, and what I want to talk about today is what is a promissory note. So when you buy a house, two instruments are recorded. One is a promissory note and the other is a mortgage or a deed of trust, depending on what state you're in. So the promissory note basically establishes the terms of the loan. It talks about the interest rate, how many months or years you're going to be paying on it, what the monthly payment is. It's basically an IOU that the bank holds. Now the mortgage or the deed of trust is what the homeowner holds, and it shows that they have equity in that property, they're responsible for it. They have some ownership to this property or to the house that they're buying off of the bank or from the bank. So there's two types of there's two types of promissory notes. There's performing and non-performing. So performing is what it sounds like. A borrower went to the bank, they established a loan, they've been making the payments on time, and it looks like they're going to see that loan all the way through to the end of the final payment. Non-performing means that a borrower went to the bank, they received a loan from them, and somewhere along the way they stopped paying for whatever reason. Maybe there was a death in the family, maybe they got sick, maybe a job loss, whatever the reason is, somewhere they stopped paying. So in either accounts, banks are not in the business of holding and selling real estate. What the banks are in business for is creating and recreating loans. So if you've ever had a house, maybe you established it with Bank of America, 6 to 8 months down the line or a year down the line, you get a letter saying now you need to make your payments to Wells Fargo. The reason is that Bank of America made their money up front with commissions. They made their money by generating or originating this loan, but now they're going to sell it off to the next person for 80 to 90% on the dollar, so that there's some skin in the game for the next person to make a profit. But now they got money back, regenerating them, where they can create new loans for their other clients and customers. So Wells Fargo will take on the remaining years that need to be paid off, and they still got a discount on what they bought the note for. Now, non-performing, the banks are regulated by these regulators who will check and do audits to see how many liabilities and how many assets they have on their books. Now, if they have too many liabilities, these banks can be shut down. So the banks will sell these non-performing at anywhere from 30 to 60% off, sometimes higher depending on what state it's in. But they need to get these off their books so that way they can clear themselves. So what they do is they sell it to smaller banks, they sell it to hedge funds, they sell it to private investors, and that's where I come in and get those. So an example that I like to use is, let's say, a house and a car. So let's say the house is the car, you buy the car. Well, the pink slip is the promissory note that the bank or your lender holds while you're getting the benefits of using the car or living in the house. So your mortgage or your deed of trust would be equivalent to your registration. You get pulled over, but it shows that you have ownership, that you're allowed to drive that vehicle, that you are the one who's paying on it, so it's not stolen. So that's basically what your mortgage or your deed of trust is. But in the same way, if somebody defaults or they stop paying on that car, it's going to get repoed, while the bank will foreclose. And if not, they sell that promissory note off. It's the same way. You're not going to get the pink slip until the car's paid off, so you don't get the promissory note until the house is paid off. So in a nutshell, that's what a promissory note is.